In this video we're going to be discussing the exchange rate and how the value of the exchange rate is determined within Australia, as well as the difference between the trade weighted index and measuring Australia's currency just using one particular other currency. So basically the exchange rate measures the price or value of the Australian dollar when it is swapped for other countries. So we've talked a fair bit in class already about the impacts of the exchange rate. Now we're really talking about how it's determined and why the Australian dollar goes up or down. The exchange rate can be basically explained in two different ways. It can measure the Australian dollar in comparison to another countries, and generally we measure it in comparison to the US dollar. That will generally be the most often quoted exchange rate. But they also measure a thing called the trade weighted index, which measures the value of the Australian dollar against a basket of our foreign currencies, of other foreign currencies. And they're each weighted according to their relative importance. So what I mean by that is that they're all weighted based on how much we trade with other countries. So in Australia we trade with China more, so that receives a higher weighting. And if our dollar goes up against the Chinese yuan or renminbi, that will lead to have a bigger impact than if it goes up against a country that we trade with less, like South Africa. So the trade weighted index basically is a measure of the exchange rate. If the TWI goes up, that's the same thing as saying the dollar is appreciating. If the TWI goes down, it's the same thing as saying the dollar is depreciating. The trade weighted index is very important because it measures how our ability to trade with our foreign trading partners. When the Australian dollar is low in terms of the TWI, it means that imports will be more expensive, but there'll also be more demand for our exports. So the Australian dollar, this is the TWI, and as you can see it has fallen in recent times, which basically means the exchange rate has fallen compared to other currencies. So just like the US dollar, the trade weighted index has fallen. Technically the TWI can go down and the against the US dollar go up. It all depends on the relative demand and supply for each different currency. So Australian dollar can go up against one currency and down against another currency. It all depends on the relative demand and supply for each particular currency. So this is basically how the TWI is calculated. This is just the weightings. So you can see that China's got the highest weighting, then Japan, then the US, and then all the way down to South Africa, which has a really small weighting. That'll be that one there. It didn't even have a weighting in 2014, and then we started trading with them more, so they got a little bit of a weighting. But nearly a quarter of our total weighting is China. So what does a floating dollar mean? Basically what the floating exchange rate means is that the exchange rate will go up and down based on the demand and supply for our dollar. So the floating the dollar meant that its value would be determined by the supply and demand for this dollar in the foreign exchange market. The easiest way to try and work out if something's going to appreciate or depreciate the dollar is it a debit or a credit? Any credits, whether it's in the financial account or in the current account, will be extra demand for the dollar and will lead to an appreciation. Anything that's going to cause more debits will lead to a depreciation. So as long as you know your debits and your credits in your current account and financial account, if you know something's a credit, you know it's going to appreciate the dollar. So the value of the dollar reflects the changes in demand and supply of each currency on the foreign exchange market. If there's more demand for the Australian currency or less supply, its value will go up. If there's more supply or less demand, its value will go down. So think of it as just like microeconomics. If the demand curve shifts to the right or the supply curve shifts to the left, the price is going to go up. And if the demand curve shifts to the left or the supply curve shifts to the right, the value is going to go down. So here's the Australian dollar. When there's more demand for our currency, the demand curve shifts to the right in the foreign exchange market. That leads to a shortage at the old price, just like in microeconomics, and therefore to get rid of the shortage on the foreign exchange market, they increase the price of the dollar, or the dollar appreciates. Shortage at the old price, the dollar appreciates. If supply increases, there'll be a surplus of our currency at the old price, and that will cause a depreciation. So, for example, I don't have that slide here, but I'll show you one in a second. The lower the Australian dollar, the higher the demand for our exports, generally, and therefore that's why the curve is kind of downward sloping. What we're basically saying there is that at a low price there'll be more demand for our dollar, and at a high price there will be less demand for our dollar. But what shifts it is some other factors. What's more important is what shifts the curve. The higher the Australian dollar, the more that is supplied, as the incentive to import is higher. More Australian dollars will be supplied at a higher price. We'll talk about that a little bit more, but it's more important you know what shifts the curve. Demand and supply of the Australian dollar. Okay, if an overseas US citizens demand our exports, so they're demanding Australian products, what they would do is they supply their US dollars to the Forex market. So they like go up to one of those stores, or they find some way to supply their dollar and convert it into Australian dollars. So anytime someone's buying a product from Australia, they will demand Australian dollars. If we purchase imports from the USA, then essentially we go to the forex market, we convert our currency, so we supply Australian dollars, and we demand US currency. So basically what's going to happen is those Australian dollars that we supply to them will end up being converted into American dollars, because that's what the American citizen's going to get when they sell us the import. If our interest rates increase, and we'll talk about this more in the next video, it will lead to more demand for the Australian dollar, because foreign citizens are going to want to put their money in our banks. They're going to want to invest in Australia because they're going to get a higher return. There'll be less supply of the Australian dollar because less Australians will be investing overseas, because they're better off investing in Australia where they're going to get a higher return. Remember that interest rates being high is good for people that are saving or investing. So when interest rates are higher, the Australian dollar will generally appreciate because more foreigners will put their money in Australian banks and less Australians will supply the Australian dollar to borrow abroad. As I said, appreciation is basically caused by a shift in the demand curve to the right. It will lead to a shortage and therefore a higher price. If the supply curve shifts to the right, we're going to have a surplus at the old price, so this value here, and that will lead to a lower price because there's excess supply in the market. In the next video, we're going to look at all the things that cause the demand and supply for the dollar to change.